Welcome to our quarterly video for the March quarter. I guess there's probably 4 or 5 main points that I think stood out over the quarter. First of all, there was obviously a very big move in continental European stocks. Second, obviously Greece is in the headlines every day, and we've recently just come back from Greece. The most interesting point to me is, in fact, the dilemma over what the zero rates in Europe actually mean, and we'll talk a little bit about that. The usual commentary on or discussion points on the US dollar, the Aussie dollar, has it fallen far enough? And when will the Fed, if they ever do, raise rates? And I think the other interesting point is in Australia that the bank stocks have actually recently moved through to an all-time high in terms of their share of the local market index. And that's usually a point where you really want to have a very, very careful think about whether you want to continue to hold those sort of investments. So if we maybe start off on Europe, where we've just come back from a 2-week trip, and there was an article in today's AFR where I actually go into a bit of detail in terms of our findings on Europe. So I'd recommend that you read the article that we'll forward with our quarterly report. But the quick snapshot is, first of all, on Greece. Greece was very interesting. I guess first from the point of view that I'd been to Argentina in '94 when they had the Argentina debt crisis, and also in Ireland at the peak of their crisis. So you had certain expectations on Greece, but when I arrived in Greece, it really didn't feel like a place that had been through a Great Depression. Coca-Cola volumes, for example, have been down 40%. To give you a feel for how the consumer's been reacting, and obviously there's talk of them potentially leaving the euro. But walking around the streets, talking to people, just seemed like business as usual. Activity levels were really low. It was really strange feeling. Cheap, but not outlandishly cheap. Now, having said that, if we were totally confident that the Greeks would stay in the euro, we would be buying shares and property there now. But I basically came away with the view that it's a 50-50 bet. My instincts tell me they'll stay in the euro, they'll cave in at the end and meet the demands of the Germans. But unfortunately, being a new government, they might also do something stupid and just by accident get pushed out of the euro. So we basically decided that we'll pass and wait and see what happens. In terms of its impact on Europe, I don't think it really matters. Everyone's up to speed on it now, and I think it'll be just a little speed bump, to be honest, if it does happen. More importantly, what's happening in Europe itself? Well, it's just like our comments of previous quarters, where we believe that it was the US with a 2-year lag. It will slowly recover. You've got the benefits of lower rates, lower oil prices, lower euro, and you're seeing that now in the periphery, where places like Spain and Ireland are starting to, well, Ireland's growing very strongly. Spain's starting to grow employment growth. So again, just like the US, it's going to be 2 steps forward, 1 step back. In fact, the one area that did surprise me a little bit was London. It's actually a lot hotter than people realise. So definitely, Europe's on a recovery path. That's the reason why the European stocks moved so hard over the quarter. But in reality, we sit here today, and they've probably caught up with the US. So it's really, there's no real disparities out there in terms of valuation. Most areas are pretty reasonably priced. And with the European economies recovering, it's obviously very good for our European property and banking plays. Going forward, in terms of ideas we're looking for, it's very much focused on stocks that you can see a big earnings recovery, because the valuation or the re-rating in valuations has already occurred. Everyone keeps asking about the dollar. It has had a big move, and the Aussie dollar has had a big move down. So the reality is, short term, I suspect it's going to chop around. Could go up, could go down. Medium to longer term, still believe though that the Australian dollar is going down. Commodity prices continue to fall. We think they're going to have a tough time over the next few years. Supply continues to come on. And the most, probably the biggest impact on the Australian dollar has been the interest differentials between overseas and Australia. And if you actually look at some of the long-term bond charts, what you'll find now is that the differential between Australia and offshore markets is getting pretty close to when the Australian dollar was selling at 50 cents. So we think once short-term interest rate differentials close, that you'll see the next leg down the Australian dollar. So we continue to be 100% offshore. In terms of zero rates in Europe, that's to me the most interesting aspect of markets today. What does it really mean when you can get 0% on a 10-year Swiss government bond? The reality is I don't think anyone knows. We're all trying to work it out. The reality is you're going to have to rewrite textbooks because it certainly wasn't in my university textbook. And you now have the crazy situation where you've actually got negative yields in some of the markets. And there was an article in the FT recently about how one home loan owner actually got a cheque from the bank on his home loan because his home loan rate was now negative. So that's something that we're all thinking hard about, but all I can tell you is in that sort of environment, probably the best thing to do is just really focus on two things, yield and growth. And if you look at the core of our portfolio, pretty much that's what we've been doing. So if you look at our property stocks, the big recovery in rents and yield in Europe. Secondly, our domestic banking franchises, particularly in Europe, which will be paying 6 and 7% dividend yields over the next couple of years. Basically CBA, but at a much lower price. And then we have our sort of monopolistic growth type businesses like our payment processors, Visa, MasterCard, the Googles of the world, etc., which have no debt. The historic growth rates have been 15 to 20%. And they're selling on reasonable valuations, but the earnings growth alone will give us what we want. And as we said, they're very dominant businesses. And then finally, our brewing and spirits businesses around the world, which are benefiting from the fall in the euro, but basically are a sort of a mixture of a dividend in yield and growth. So they're the sort of key points coming out of the quarter. Again, please read through the article that was in the AFR today. I think it'll give you a good snapshot of our views on Europe. But I guess finishing off, the one thing I would emphasise is the markets have had a good move. We do still like the businesses we own, but they're going to give us satisfactory returns over time. But sometimes you just have to be a little bit patient. And I think markets might chop around a little bit in the short term. But fundamentally, we're still happy owning what we want. And we certainly believe that they're a much better investment than the interest rates you're getting on term deposits or government bonds or cash. In fact, the yield between owning a business and owning government debt are still at record levels. So we prefer to own the business.